Today's episode is what I call the Geopolitical Traders Survival Guide. We're going to dissect how Bitcoin dropped from 108,500 to 103,000 in a matter of hours. Analyze $1.15 billion in liquidations that just swept through the market and give you a complete playbook for navigating the next 24 to 48 hours. We've got institutional money fleeing to gold, hedge funds scrambling to staff weekend trading desks, and some of the smartest analysts in the world still calling for 200,000 Bitcoin by year end despite the current turmoil. Let's start with what just happened because understanding the immediate catalyst is crucial for predicting what comes next. Early Friday morning, Israel launched what they're calling Operation Lion's Roar against Iranian military targets near Tehran and Tabriz. The immediate market response was swift and brutal. Bitcoin plunged 5% to $102,900 within hours, while spot gold jumped to $3,429 as investors executed the classic flight to safety trade. But here's where it gets interesting from a trading perspective. Bitcoin initially dipped on just the reports that Israel had notified US officials about planned strikes, then staged a partial recovery from $107,000 to $108,450 as markets digested the news. This tells us something crucial about market psychology. The initial reaction was fear-driven, but the recovery suggests that institutional buyers were waiting for exactly this kind of dip. The numbers are staggering, and every trader needs to understand their significance. According to CoinGlass data, over $1.15 billion in leverage positions were liquidated across crypto markets in the past 24 hours. That's not just retail traders getting wiped out, that's institutional-grade money getting caught on the wrong side of a geopolitical surprise. The largest single liquidation order occurred on Binance, involving BTC-USDT valued at $201.31 million. When you see liquidations of this magnitude, it creates opportunities for those with dry powder and strong risk management. Bitcoin saw over $448 million in liquidations alone, while Ethereum experienced $288.4 million. But here's what most analysts are missing. These massive liquidations often mark capitulation points where smart money starts accumulating. The fear, uncertainty, and doubt that drives retail investors to panic sell is exactly what creates the conditions for institutional accumulation. The broader market context is equally important. Asian equities traded in the red across the board, with major indexes declining as geopolitical risk intensified. The US dollar index dropped to 98.5, its lowest level in months, which historically creates a favorable environment for alternative stores of value like Bitcoin. When the world's reserve currency weakens amid global uncertainty, it often drives demand for assets that aren't tied to any single government or central bank. What's particularly fascinating is the divergence we're seeing between traditional safe havens and digital assets. Gold is behaving exactly as textbook economics would predict, surging to new highs near $3,444. But Bitcoin's reaction is more nuanced. It's trading like a risk asset in the short term while maintaining its long-term value proposition as digital gold. This dual nature is exactly what creates both volatility and opportunity for sophisticated traders. Now let's talk about what history teaches us, because if you're going to trade geopolitical events successfully, you need to understand the patterns that repeat across different crises. I've analyzed data from crypto labs covering 7 major geopolitical events since 2019, and the patterns are remarkably consistent and profitable for those who understand them. Here's the data that should change how you think about geopolitical dips. Bitcoin averages 23% gains within 15 days after geopolitical crisis. That's not a typo. 23% average gains within 2 weeks. Even more compelling, 90% of conflict-related dips fully recover within 3 weeks. This isn't speculation or hopeful thinking. This is mathematical analysis of how markets actually behave when geopolitical tensions spike. But here's the pattern that most traders miss. The initial reaction is almost always an overreaction. Markets price in worst-case scenarios immediately, then gradually adjust as the actual impact becomes clear. The April 2024 strikes that Ryan McMillan from Merkletree Capital referenced are a perfect example. Weekend crypto sell-offs were followed by 30% rebounds as markets realized that regional conflicts, while serious, don't fundamentally change Bitcoin's value proposition. What's changed dramatically since 2020 is the correlation between Bitcoin and traditional safe havens during crises. The gold-Bitcoin correlation during geopolitical events has dropped from 0.82 in 2020 to just 0.37 in 2025. This tells us that Bitcoin is maturing as an asset class and developing its own response patterns to global events. It's no longer simply following gold's playbook, it's writing its own. The institutional ownership factor cannot be overstated. Hedge funds now hold 41% of all Bitcoin ETF shares, surpassing investment advisors for the first time. This institutional backbone provides stability that didn't exist in previous cycles. When retail investors panic, institutional portfolios provide a floor. When prices drop to attractive levels, institutional algorithms start accumulating. This creates a different risk-reward profile than we've seen in previous geopolitical events. Here's a pattern that weekend traders need to understand. Crypto markets are especially volatile during geopolitical developments that occur on weekends. Unlike traditional markets that close, crypto never sleeps, which means that weekend events can create amplified moves due to thinner liquidity and reduced institutional coverage. But here's the opportunity. Major hedge funds like Cube Research, Virtu Financial, and Jump Trading are now hiring specifically for weekend crypto trading roles. This means the liquidity gap that created weekend volatility is being filled by professional traders. The evolution of Bitcoin as digital gold is accelerating during each geopolitical crisis. While physical gold gained 2.3% during the current tensions, Bitcoin's 2025 year-to-date performance of plus 110% versus gold's plus 8% confirms its maturation as a superior store of value for the digital age. Physical gold can't match Bitcoin's settlement speed, verifiable scarcity, or 24/7 accessibility during crisis periods. Let's dive into what the smartest money in the room is thinking, because understanding institutional perspective can give you a significant edge in positioning for the next move. Boris Allegand, head of institutional partnerships at Babylon and a former Ripple and JP Morgan executive, provided perhaps the most balanced analysis I've seen. He acknowledges that Bitcoin continues to trade like a classic risk-on asset, responding sharply to macro tailwinds, but emphasizes that the broader picture for BTC remains optimistic. What makes Allegand's analysis particularly valuable is his observation about institutional adoption patterns. More institutions are emulating MicroStrategy's BTC treasury strategy, creating a steady base of structural demand. This isn't just about price speculation. This is about fundamental changes in how corporations and institutions view Bitcoin as a treasury asset. When companies start holding Bitcoin on their balance sheets as a hedge against currency debasement and inflation, it creates a demand floor that didn't exist in previous cycles. James Butterfield from CoinShares provided data that should make every trader pay attention. $900 million in new digital asset fund inflows this week alone. This is happening while Bitcoin is experiencing geopolitical pressure, which suggests that institutional investors are viewing current prices as attractive entry points rather than reasons to flee. This resurgence comes as Bitcoin trades near all-time highs and global money supply conditions loosen, suggesting there could be further upside potential for digital asset prices more broadly. The Federal Reserve policy implications are crucial for understanding the medium-term outlook. Consumer prices rose less than forecast last month, increasing the probability of Fed rate cuts. With core inflation stable at 2.8%, traders are now largely expecting 2 cuts this year, beginning in September, according to the CME's FedWatch tool. Rate cuts historically benefit risk assets, including cryptocurrencies, by reducing the opportunity cost of holding non-yielding assets. Yue Yang, chief economist at BIT Mining, highlighted a regulatory development that most traders are overlooking. This marks the first time the SEC has shown coordinated openness to both Layer 1 assets and the DeFi ecosystem. The SEC's recent willingness to greenlight ETF applications tied to altcoins like Solana is creating what analysts are calling an altcoin ETF summer. This regulatory clarity removes uncertainty that has historically weighed on crypto valuations. Here's the institutional perspective that should influence your trading decisions. Despite the current geopolitical tensions, CoinDesk analysts maintain that 200,000 Bitcoin is still in play by year end. This isn't based on hopeful speculation. It's based on the convergence of multiple factors, including institutional adoption, regulatory clarity, monetary policy, and the mathematical scarcity of Bitcoin supply. The weekend trading dynamics have fundamentally changed due to institutional participation. Traditional finance is adapting to crypto's 24/7 nature by hiring weekend trading teams. This means that the thin liquidity and amplified volatility that historically characterized weekend crypto trading is being dampened by professional market makers. For retail traders, this creates both challenges and opportunities. Moves may be less extreme, but they're also more predictable and follow traditional technical analysis more closely. Now, let's get into the technical meat and potatoes that will determine your trading success over the next 24 to 48 hours. Bitcoin's current position above $103,000 represents a critical inflection point, and understanding the key levels will help you position for the next major move. The immediate support structure is built around the $102,000 to $103,000 zone, which represents a high demand area where institutional buyers have historically stepped in. This level has been tested multiple times during the current geopolitical tensions and has held firm, suggesting that there's significant buying interest at these prices. Below this, the next major support sits at $100,372, which represents the 30-day low and a psychological level that would likely trigger significant institutional accumulation. The 50-day exponential moving average at $104,458 is particularly important because it's acted as dynamic support during the recent consolidation. A daily close below this level would suggest that the current pullback is more than just a geopolitical reaction. It would indicate a potential shift in the underlying trend structure. Conversely, a reclaim and hold above this level would suggest that the dip is being bought and that the uptrend remains intact. From a resistance perspective, the $105,500 to $106,600 zone represents the first major hurdle for any recovery attempt. This area contains multiple technical confluences, including previous support that should now act as a resistance and the 20-day moving average. A break above this zone with volume would suggest that the geopolitical selling pressure is being absorbed and that buyers are regaining control. The key breakout level that every trader should have on their radar is $108,000. This represents the level where Bitcoin was trading before the geopolitical tensions escalated, and a reclaim of this level would likely trigger algorithmic buying from institutional players. Above $108,000, the path to the previous all-time high of $111,980 becomes much clearer from a technical perspective. The moving average convergence divergence indicator is showing a failed bullish reversal, with bearish histograms indicating that the selling pressure is accelerating. However, this needs to be viewed in the context of the geopolitical catalyst rather than a fundamental breakdown in Bitcoin's technical structure. The relative strength index has dipped below the neutral 50 level, indicating fading bullish momentum, but it's not yet in oversold territory where we typically see strong bounces. Here's a technical pattern that should concern Bitcoin bulls: the emergence of a fractal pattern that resembles the price action from January 2025. The current situation shows similarities to a previous period where BTC rallied from 91,700 to 102,700 before experiencing a sharp decline. The pattern includes a break of a downward trend line after 3 to 4 weeks of consolidation, failure to reach fresh all-time highs, and RSI turning down at the 60 level after bouncing from below 50. If this fractal pattern continues to play out, Bitcoin could face a strong rejection that brings prices down to the $100,000 psychological support level. However, if Bitcoin can reclaim and hold above $108,000, the fractal pattern would be invalidated and the bullish thesis would remain intact. Now, let's get to what you really came here for: specific, actionable trading strategies for navigating the next 24 to 48 hours. I'm going to give you 3 different approaches depending on your risk tolerance, time horizon, and trading style, because one size definitely doesn't fit all when it comes to geopolitical trading. Strategy number 1 is what I call the geopolitical scalper. This approach is designed for traders who want to capture quick moves during periods of heightened volatility. For Bitcoin, you're looking for entries on any bounce toward the 104,500 to 105,000 resistance zone, with tight stops at 103,500 and targets at 106,500 to 107,000. The key trigger here is volume. You want to see at least a 30% increase in hourly volume to confirm that the bounce has institutional backing rather than just retail hope. The beauty of this strategy is that it takes advantage of the increased volatility while managing risk tightly. Geopolitical events create emotional trading, which often leads to overshoots in both directions. By positioning for counter-trend bounces with tight risk management, you can capture these emotional moves while limiting your downside exposure. For Ethereum scalpers, the setup is even more attractive due to its relative strength during the sell-off. Any retest of the 2,500 to 2,550 support zone represents a high probability long entry with targets at 2,650 and 2,750. Ethereum's correlation with Bitcoin during geopolitical events is typically high, but it often recovers faster due to its additional utility value and staking yield. Strategy number 2 is the crisis accumulator. This approach is designed for traders with longer time horizons who want to take advantage of the historical pattern showing that 90% of geopolitical dips recover within 3 weeks. The entry strategy is to scale into positions on any further weakness, with the largest allocation reserved for a test of the 100,000 to 102,000 zone. The key to this strategy is position sizing and patience. You're not trying to catch the exact bottom. You're trying to accumulate a meaningful position during a period when fear is driving prices below fair value. Historical data suggests that buying during geopolitical crises and holding for 2 to 4 weeks has been one of the most profitable strategies in crypto trading. Your stop loss for this strategy should be a daily close below $98,000. Which would represent a breakdown of the major support structure and suggest that the geopolitical tensions are having a more fundamental impact on Bitcoin's adoption trajectory. Your targets are $115,000 and $125,000, representing the next major resistance levels once the geopolitical premium is removed from the market. Strategy number 3 is the weekend warrior. This approach takes advantage of the unique dynamics of weekend crypto trading during geopolitical events. Weekend liquidity is typically thinner, which means that moves can be more extreme in both directions. However, with major hedge funds now staffing weekend trading desks, the dynamics are changing. The strategy involves monitoring news flow closely and positioning for gap fills when markets reopen on Monday. If Bitcoin gaps down significantly on Sunday evening due to escalating tensions, you're looking to fade that gap with tight stops. Conversely, if positive developments emerge over the weekend, you're positioning for a gap up that could trigger short covering and momentum buying. Risk management is absolutely crucial for all 3 strategies. The geopolitical environment can change rapidly, and what looks like a buying opportunity can quickly turn into a falling knife if tensions escalate unexpectedly. Never risk more than 2% of your trading capital on any single trade, and always have a plan for both bullish and bearish scenarios. Here's a specific setup that I'll be watching closely. If Bitcoin can reclaim $105,000 with volume exceeding $3 billion in daily trading, it would suggest that the geopolitical selling pressure is being absorbed and that institutional buyers are stepping in. This would set up a potential squeeze back toward $108,000 to $110,000 as shorts cover and momentum buyers return. Conversely, if Bitcoin breaks below $102,000 with conviction, it would likely trigger a test of the $100,000 psychological level. This would represent a 7 to 8% decline from current levels, which historically has been where institutional buyers become very aggressive during geopolitical dips. The next 48 hours are absolutely critical for determining whether this geopolitical dip becomes a buying opportunity or the start of a deeper correction. I'm going to give you the specific triggers and monitoring points that will help you navigate this weekend like a professional trader. First and most important is the news flow monitoring. Geopolitical situations can escalate or de-escalate rapidly, and crypto markets will react to every headline. You need to be monitoring multiple news sources, including traditional financial media, crypto-specific outlets, and social media for real-time updates. The key is to distinguish between noise and signal. Not every headline will move markets, but the ones that do can create significant opportunities. Here are the specific technical triggers I'll be watching. Bitcoin daily close above $105,000 would suggest that the selling pressure is being absorbed and that buyers are regaining control. This would likely trigger short covering and momentum buying that could push prices back toward $108,000 to $110,000. Conversely, a daily close below $102,000 would suggest that the geopolitical tensions are having a more significant impact and could trigger a test of $100,000. Volume is absolutely crucial during geopolitical events. You want to see volume confirmation on any significant moves. A breakout above resistance without volume is likely to fail, while a breakdown below support with high volume is likely to continue. The volume threshold I'm watching is $3 billion in daily Bitcoin trading volume. Above this level suggests institutional participation. Below it suggests primarily retail-driven moves. The correlation with traditional markets will be important to monitor. If U.S. stock futures gap down significantly on Sunday evening due to escalating tensions, it will likely pressure crypto markets as well. Conversely, if traditional markets show resilience, it could provide a tailwind for crypto recovery. The key correlation to watch is with gold. If gold continues to surge while Bitcoin stabilizes, it suggests that Bitcoin is finding its footing as a distinct asset class. Oil prices are another crucial indicator. Geopolitical tensions in the Middle East typically drive oil prices higher, which can have inflationary implications and affect central bank policy. If oil spikes above $85 to $90 per barrel, it could complicate the Federal Reserve's dovish pivot and pressure risk assets, including crypto. Here's a weekend-specific trigger that many traders overlook. Sunday evening Asian market open. Asian markets often set the tone for the week, and if they gap down significantly due to geopolitical tensions, it typically pressures crypto markets as well. Conversely, if Asian markets show resilience, it often provides a bid for risk assets, including Bitcoin. The options market is providing some interesting signals that traders should monitor. Bitcoin options skew has hit a 3-month low, suggesting that the fear premium has been largely priced out. This could indicate that the worst of the selling pressure is behind us, but it also means that any escalation could catch the market off guard. Institutional flow data will be crucial to monitor. If we see continued inflows into Bitcoin ETFs despite the geopolitical tensions, it would suggest that institutional investors are viewing current prices as attractive entry points. Conversely, if we see significant outflows, it would suggest that institutions are reducing risk exposure due to the uncertain environment. Let me be absolutely clear about something. Trading during geopolitical events requires a different approach to risk management than normal market conditions. The volatility is higher, the news flow is unpredictable, and the correlation between assets can change rapidly. If you don't adjust your risk management accordingly, you're essentially gambling rather than trading. The first principle is position sizing. During normal market conditions, you might risk 2 to 3% of your capital on a high conviction trade. During geopolitical events, that should be reduced to 1 to 1.5% maximum. The reason is simple. The probability of gap moves and unexpected developments is much higher, which means your stop losses might not be honored at the levels you expect. Correlation risk becomes extremely important during geopolitical events. Assets that normally have low correlation can suddenly move together when fear dominates the market. If you have long positions in both Bitcoin and Ethereum, you're not really diversifying your risk. You're doubling down on the same directional bet. Consider this when sizing your positions across different cryptocurrencies. The concept of heat is crucial for active traders during volatile periods. Heat refers to the total amount of capital you have at risk across all your open positions, even if each individual position only risks 1% of your capital. Having 10 positions open simultaneously means you have 10% of your capital at risk. During geopolitical events, correlations increase and all your positions can move against you simultaneously.